the Federal Reserve's decisions on interest rates don't just affect Wall Street. They actually have an impact on whether or not you can afford your next home. And in today's episode, we're talking about the Fed's policies and their effect on the 2025 housing market.
Jeb, I think the Fed gets way too much credit for actual impact on the market. But what we all can agree on is they're the loudest voice in the room. When the Fed talks, everyone listens. When we get a meeting like we just had this week where they do their summary of economic projections, the world looks and goes, this is what the Fed says is going to happen over the next 12 months. But the funny thing is, every 3 months we get a new one and they vary a ton. And now we act like the new one is the gospel truth.
Well, I'm actually going to disagree, because if they came out today and said that, hey, inflation's under control, we're going to cut rates, so on and so forth, rates would go lower, and that would be a positive for the housing. So their voice is loud and their voice is impactful at the moment.
You guys watching at home are probably used to 3 years, 150 episodes of Jeb and I agreeing. I could not disagree more. The Fed does not have that type of credibility with the current market. If they came out tomorrow after what they've done the last 6 months, 12 months, 24 months and said, guys, we've got inflation under control. We got a great PCE number today. We're cutting rates another 25 basis points because we're on the right path. The market would lose its mind and go, these people are idiots. They're leading us back to hyperinflation, and rates would get worse. So there, Jeb and I disagree. Polar opposites.
That'd be interesting. Yeah, I think the bond market would go the other direction. But nevertheless, we're going to talk about what's impacting now, right? So the last couple of days have had a huge, at the time we're filming this rather, impact on the 10-year and their outlook for 2025. And the idea here is that whether or not you believe they're the loudest in the room or whether or not their impact is real, the reality is what they're doing at the moment is creating volatility. And that volatility is going to have an impact on the housing market, positive and or negative, depending on the direction they're going. So let's talk, Josh, about what they're saying at the moment, predictions of what they're expected to do, and even looking at predictions of what they expected to do in 2024, because I think everybody looks right now and go, well, they did what they said. No, they actually got a little bit more aggressive than they had stated at the beginning of the year. And so just because they're saying something now doesn't mean it can't change.
Well, a year ago, the markets were well ahead of the Fed. The Fed had not indicated that they were going to cut, and the markets had taken rates down into the low sixes in terms of mortgage rates. Treasuries were at the lowest levels in 6 or 8 months because they were believing, the markets were believing, despite the Fed not really buying into it just yet, that inflation was under control, part of the Fed's dual mandate. And what did we see? January, February, March, hot jobs numbers, hot inflation numbers, and we shot back up. By the middle of the year is when we started seeing the Fed saying, all right, these numbers are normalizing. We thought January, February, March were an aberration, but that's the problem, that we're seeing these whipsaws and this volatility across the market. And the Fed, I mean, this is not to say these guys are idiots. I've said many times here on the show, some of the smartest economists in the world, they have the best data. They get together full time and talk and debate and pass things around. We have incomplete information. We are still dealing with the ripple effects of COVID. For us, you mentioned on the last show, hey, it's been 5 years almost since COVID first jumped out at the beginning of 2020. You're like, that's wild that it's been that long. But since the market distortions, it's been 2.5 years. So it hasn't been all that long. So we're seeing less market distortion, but it's still there. And the Fed's trying to deal with that. So we get what we have right now. In September, they come out and say, inflation's under control. We're concerned about the job market cooling. We're cutting because right now we are too restrictive. So for those of you watching at home, you probably hear crazy wonky terms like R-star, the neutral rate. That it's theoretical. No one can know what it is. But what the Fed thinks it is important, because right now they have the Fed funds rate above that neutral rate, which means they're restrictive. Foot on the brake, simply saying. So they still have room in their minds to cut some more and still have their foot on the brake. Whereas coming out of COVID, for too long, they had their foot on the gas when they should have had their foot on the brake, because we had a very accommodative policy. So why do we care about the Fed? Because they sort of set the tone for the market and they have the market's ear. Every 8 weeks, every 6 weeks, 8 times a year, and 4 times a year, they get to put out their projections of what happens in the next 12 months. And we're 2 days from that as we record. And that means that for the next 2, 3, 4 weeks, everyone's focused on what the Fed thinks, even though they don't really have any better insights than any other economist in the world.
So biggest changes, Josh, in September to today, right? We were talking prior to coming on here, is that they no longer believe that that inflation is necessarily under control, right? And they no longer believe that the job market is cooling quite as much as they had first anticipated. So let's dive into that. But before we do that, I think it's important to understand the Fed's position previously. Like, what have they previously done? They've previously let things get so far out of control, like they've let the pendulum rather swing to one side before they have any say or do anything, which is super easy money, accommodative policy, so on and so forth. Interest rates for too low for too long. Pendulum swung. Oh crap! Inflation's out of control. What do? We get super aggressive. We hike from 0% up to 5.5% on the Fed funds rate in pretty much a straight line up. Oh crap! Now we're too restrictive. Going back down, but now maybe changing the stance a little bit, Josh. Instead of letting themselves get ahead by becoming less restrictive, they're saying, "Oh, maybe we're going to wait and see what happens with Trump, with some of the policies, with how these things actually impact the economy, and whether or not it is going to have an impact on inflation."
Absolutely. So they, in the meeting, the press conference, so they have a statement. The statement doesn't tell us a whole heck of a lot. The greatest insights that we get into the Fed is both the dot plots, the chart that they put out that says what their expectations are, and the press conference from Powell. And he had indicated a couple of things there. They have gone from the stance of saying, hey, we're going to wait until the new president's policies are actually enacted. So we have an idea, but like we've said here on the show, we don't know what he's actually going to propose and then get through and then how that impacts. Well, they had a statement here that I wish I had the quote here in front of me, but basically they went from saying we're going to wait and see how it plays out to kind of wanting to get ahead of it, where instead of being reactive, they're going to say, we're worried that some of these policies could lead to higher inflation, could worsen wage inflation. I was going to say strengthen the job market, but there's some fear that if immigration is decreased to a great degree, there will be less people to fill jobs, which will lead to wage-based inflation and sort of this spiral.
Right.
So that's what the Fed is looking at. And again, we're dealing with probably more uncertainty than we've ever had. You talk about whipsaws in the market. I don't know. I'm sure we have had a president who had a gap in their terms, but we have, hey, no.
I don't think we ever have.
Okay, so you have Trump here. We go, no Trump, we're going to have Biden. Biden, two couldn't be more opposite. And at the end of those 4 years, the American populace does a whipsaw and goes, no, we do want Trump back. So we have the markets, we have COVID, we have Fed, we have the presidency. There's so much uncertainty, and that's what the Fed is dealing with. And I think what we are seeing is they would rather remain what they perceive to be excessively restrictive to keep the foot on the brake, to make sure that we don't see additional inflation or inflation reaccelerating. So right. We're above where they want to be. We're in the mid to high twos, and they want it to be at 2. And over the last 3 months, we haven't made progress towards that if you're looking at the numbers that have been released. But Jeb, the important part is to dig into those numbers. And the last CPI figure, the last PCE figure, we finally saw a break in the measurement of shelter inflation. And if that continues going forward, you could, I won't say you will, you could by mid-year see numbers on core PCE, core CPI being in that 2% range. So things can change quickly. By June, 6 months from now, we'll know, what did Trump actually want to do? What was he able to do? How did it impact the market? Are we seeing this increase in inflation, or are the measures coming in at a much better level? And the market will move ahead of what the Fed does. But we've seen from them, they're getting whipsawed. They will adjust. We will have 2 more sets of dot plots by the middle of next year. And I would be shocked if their expectations are anywhere near what they just released this week.
Yeah, we talked, that we've gone from a Fed who is paying attention to what the data is now, to being a Fed that's kind of looking forward now. They're looking at leading indicators, things that are going to happen in the future, and going, oh, well, maybe we shouldn't do this now. Let's wait to see how this plays out, which has been completely different than what they've done in the past. They've kind of been behind the eight ball, so to speak, this entire presidency. But it'll be interesting. But let's talk about 2025 forecast for monetary policy, the changes because that did have an impact. And then let's talk about how that's going to impact housing, because I think, or how it has the potential to impact housing, because that's really where our listeners, what impacts them.
So let's talk about the volatility in these whipsaws. After September, they came out and said, hey, we're going to cut 100 basis points next year in 2025. And after 3 cuts here in 2024, well, the market went further than that. If you look at the Fed funds futures, they were predicting 1 to 2 more cuts beyond that. Well, now they came back and said, nope, we're not cutting 4 times next year. We're going to cut most likely 2 times next year. The market's pricing in only 1 cut for next year. So we have the whipsaws in terms of what the Fed says they're going to do, and then even more extreme movements in what the market thinks. So in terms of interest rates, we talk about probably our preferred economic expert on terms of rates and housing is Logan over at Housing Wire. We read 10, 15, 20 of them, but generally our consensus falls in line most closely with his. Well, Housing Wire for 2025 is not giving a target of, hey, we think rates are going to hit here. Part of that is because we're talking about a 12-month period. Mm-hmm. It's hard to say what's the average rate going to be for the next year. But because of all this volatility, they see that we could have a 5.75 rate, which would be like a 350 10-year treasury with a 2.25 spread. So mortgage rates above the 10-year treasury, or all the way up to 7.25 on the high end. And post-Fed meeting, we're already almost to 7.25, although we've seen some improvement the last couple of days. And I think that is a pretty reasonable range. And what that means for you, if you're planning and you are wanting to buy a home in 2025, I don't think you can get hung up on interest rate. And I don't think you can plan on, I'm going to buy in March because I think that's going to be the low in interest rates, or I'm going to wait till the fall because I think we're going to see this slow and steady glide. When you look over the last 2 years, we've seen swings of almost 150 basis points from the high to the low in the terms of the year. So rates as high as 8%, rates as low as 6%. So the thing that you need to be thinking is buy what you can afford. Don't stretch. Don't do anything crazy, and plan for the worst and hope for the best. So we have an example, Jeb, I've used here several times on the show. A listener, Hayden, he and his wife bought in late 2023. They were hoping for rates to drop. Well, through 2023, rates had gone up almost a full percent. From when we started looking, we were like 1.25% higher. He ended up closing at 7 3/8. Well, we caught one of those dips in the spring. We did a no-cost refinance down to 6.875. It's 0.5% on a $700,000 loan. It's real money. And what do you know? We get another dip in October, and we went down from 6.875 to 5.875. So he got what he wanted, but it was a more active, I need to manage it. And they could afford that 7.375. They weren't stretching. They didn't do some sort of temporary buy down, permanent buy down. And I think that's important for anyone listening here. You can use those as tools, but don't use them as the tool that makes this house affordable for you with the hope or the prayer that you're going to get a window to refinance again going forward. But biggest picture takeaway is if you think that you're going to project when you're going to buy over the next 12 months based off of catching a dip in the interest rates, I think it's going to be very difficult because it's going to be volatile and unpredictable.
Yeah, and while we did say in the forecast that I do think rates are going to average lower than they did in 2024, which is about 6.7%, I do believe interest rates are going to come down. Why? Because I think the Fed is being a little bit aggressive right now with their statements, and that they've set a precedent, or they've set a bar that they can change pretty easily. Like Logan said over at Housing Wire, a low bar, which means if data gets worse than they expected, they can just adjust. It's a matter of changing their statement, and the market reacts accordingly. And I think there's an opportunity for that. So with that being said, I think that we'll see likely a lower rate. But here's the thing. At the moment, you got volatility in the market. So the biggest impact on housing is going to be interest rates, because interest rates affect affordability. They affect everything. So the longer rates stay higher, I think the faster and more inventory you see on the market for a longer period of time. Whereas if interest rates come down quicker, you're going to still see inventory because it's going to unlock some of it, but you're not likely to see the homes sit quite as long because buyer demand will pick up and affordability will be improved. And so the impact is real on both sides. It doesn't mean that just because the Fed's talking now that there's not an opportunity for a better housing market in 2025, because I do believe, I mean, the last 2023, 2024 have been kind of blah markets, but honestly, they're kind of what we needed in the market coming out of 2020, 21, 22, where we saw this gangbuster craziness in the market. You needed some settling down. We've gotten a little bit more of it, getting us closer to that long-term trend in appreciation. Positive thing, right? We don't want to see year over year 10% appreciation. It just gets crazy. So I think we all have short memories. We all just remember the last couple of years, the craziness, how quickly things were selling. Homes weren't sitting on the market for very long. We're getting back now, Josh, where days on the market are 60 days, 70 days, 80 days. It might climb. Most agents haven't seen this. Most buyers haven't seen this. And so the market's not crashing. It's just some normalization back into a housing market that's had a lot of craziness. And we need some of this, unfortunately, even though it's not what we want.
And for me, listening to that, I agree pretty much with your analysis there. And for me, as if I'm playing the market, it may sound crazy, but having watched lots of people buy, finance, refinance, I look at that and I go, if I'm a buyer and I wanted to buy in the first half of the year, I would almost hope that interest rates trend a little higher through the first quarter of the year. If we get into spring and rates are 7.25%, 7.5%, that's going to be a subdued market for buyers.
Absolutely.
But there are sellers who've been waiting for the spring, waiting for the ground to thaw, and they're going to put their homes on the market. So more supply relative to limited demand, that gives you an opportunity to go in, negotiate a better price, get some closing costs covered, whatever the case may be, not get into a bidding war. And then that longer term trend is going to play out, even if the trend isn't to lower rates. That volatility where we get these dips of lower rates, you'll be able to get the lower rate later on, but being able to buy from a position of power when there's a little less demand, a little bit more supply. So again, do not hear that mantra of marry the house, date the rate. If you do that and you get a great deal on a house in the spring at 7.5% interest rate, be prepared. You may end up with a 7.5% interest rate. I don't think that's the case, but you have to be okay with it being the case versus going, okay, I'm gonna grit my teeth and just hold on and hope that later on something gets better.
Yeah, and remember, real estate's local, right? So 2025. You're going to have more of that. The new word in 2024, Josh, was the bifurcation of markets, right? Like this disparity between real estate markets. Some were doing well, some were not doing well. 2025 is going to expose more markets, I think, than anything else, where you're going to have some markets where inventory is back to 2019, 2018, 2017 levels, whatever, whereas some markets aren't going to see that, and they're still going to be gangbusters. And you're going to hear people say there's bidding wars and there's competition, and other people are going to say there's homes sitting, nobody's buying them. That is more of a normal market.
Both will be true.
Yes, and that is more of a normal market. So just understand that the Fed, they are going to continue to, deal with their dual mandate, which is basically, stable prices, stable employment, right? They don't want inflation. They don't want a crashing job market, and they don't want a job market that's going gangbusters either. They want one that's just kind of moving up at the right pace. And so until something changes there, you've got a Fed that's dealing with that. And the likelihood of it affecting the housing market is real, especially in the short term until we get some more data out there, Josh.
No, I agree. Be prepared for volatility. Be prepared for changes in incoming data, and just believe in your path. If you've decided it's the right time in your life and this is what your family needs to do, we're going to have opportunities from both sides of it.
Yeah, and if we can be a part in that process, reach out using the referral link in the description. Josh and our team here would love the opportunity to help guide you through that process. But until next time, guys, make sure you're buying right, borrowing smart, and building wealth. Adios.
Amigos.